Hit it.
It's August 28, 2020, episode 94. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back to the show David Bezic, an economic independent consultant who will walk us through how monetary and fiscal responses are affecting both the economy and markets. Then we get Patrick's favorite segment, Talking Charts.
And then in This Week in Trading History, we talk about the Western Blizzard, also known as the Panic of 1857. We then get to the WTF Clip of the Week, where we did a little mashup of good Portnoy hunting. And so you'll want to check that out. And then we cap it all off with the top 3 things to watch next week. And Kevin, we might even drink some brewskis along the way, right? So stick around. We got a great show, and let's get on to our interview.
David Bezic is an independent economic consultant specializing in the operational aspects of fiscal and monetary policy. Welcome to the show, David.
Thank you, Kevin. Glad to be back.
Yeah, it's been a year, and it's been an exciting year in that, right?
It has indeed, and especially on the modern money front, and markets are certainly interesting too.
And I, for those who don't know, David was on about a year ago, and he gave us kind of an explanation about modern monetary theory. And I explained at that time that David actually used to work at a big pension plan. And when I wrote my first piece on MMT, he reached out and said, "Hey, nice to meet you. Thanks for writing about this. And by the way, here's some more information." So he's been my go-to guy in terms of understanding MMT. And one of the things that I've found fascinating about you, David, is that you're one of the few that has taken MMT and really understood it to the point where they used it in their practicing of portfolio management. And one of the things that you've been just steadfast on is the fact that you have been bullish stocks. Now, here we are kind of with the stock market hitting new all-time highs. Big question for you. Has anything changed? Are you still bullish stocks?
Still bullish stocks. Particularly, I think last time when we spoke, we were mostly focused on the US, and that's what I tend to focus on. It's a reflection of I used to work in equity strategy, and particularly US equity strategy. And because of that, and just I guess most people tend to focus on the US. So when I say positive stocks, it's generally talking about the US. And just kind of what you were mentioning, how the MMT view has helped shape some of that equity perspective. It's also made me, on the flip side, less positive on Europe for years. And it's things I know we've talked about before. With the MMT perspective, not just providing information on the equity asset class as a whole, but also providing information on geographical differences.
Right. So why don't you walk us through why you're so bullish equities and why you haven't been shaken off in terms of this huge rally off the lows? Like what is the framework upon which you work that makes you able to still be bullish up here?
Okay. Well, I guess even separately from the MMT understanding, which has been helpful, my bias generally is equity bullish. And that's due to the simple fact that equities over time have generally gone up. So if you take any given year, it's I think 7 out of 10 years are up years, and so I just feel like it's the path of least resistance, and so that's my starting point.
Right.
And then the onus is on the bears to tell me why we're not in one of those 7 out of 10 years. So that's my starting point. In terms of the current context, just panning out on, again, the S&P and looking at it, say, over a 100-year period, you notice that there's long periods where stocks tend to do almost nothing and they go flat for 10 to 15 years. And then the bulls tend to be 10 to 15 years. So on that very panned out perspective, it still looks like early days. We had that flat 10 to 15 years from 2000 to just a few years ago, and just made new highs fairly recently. So that's my starting point, and that's separate from the MMT stuff. The MMT stuff has helped generally, and especially recently with the COVID response, where I think a lot of people have been very surprised by what's happened with markets. And we spoke early on, I know I've said this before, and I'm not just saying it, you were one of the only people I saw calling that low, or starting to move into stocks, and I was in a similar camp, and I think part of it, and we both had a similar playbook, was the fiscal response. And I feel like because there's a general lack of understanding of the way government balance sheets interact with private balance sheets, a lot of people were not able to make the connection of just exactly how important that big fiscal response was going to be, and how important not just for households and businesses, but also for markets. And so, just on the last point, in terms of how it relates to markets, one example would be uh, the way government deficits relate to corporate earnings, and it's something again people I think don't connect those dots. And so when you think about it, if government provides money to households that then gets spent, that's a source of revenue for corporations that didn't come from the businesses themselves in the form of wages.
Right.
So it becomes kind of gravy for the bottom line. And I think the earnings have been bad as expected, or bad relative to what they would be in normal times, but the beat rate is at historical highs. And I think this is an example of where that understanding of the relationship between government balance sheets and private balance sheets, I think, is an example of it is provided by the recent earnings beats.
Right. So let's go into this a little bit further, because I for one believe that COVID is let's say introduced the new era of fiscal deficits, and I talk about the fact that if you go look at the great financial crisis and the response to that, although there was some fiscal stimulus early on, it was very quickly withdrawn, and it was very quickly the deficit talks came out. All of a sudden, the government was doing pro-cyclical cuts. And I've been arguing for a while now that this isn't occurring here. And if you look at the amount of fiscal that's getting done, this is actually blowing the doors off of the previous great financial crisis. And that is why the economy is doing so well. But how long can this government continue on this? Like, is this indefinite, or is this something that they're going to pull back on? What are your worries on this side?
Well, that's precisely my worry. Is so again, just generally positive on stocks. Near term, I think the biggest risk is if that fiscal support is withdrawn, or we don't get another deal that's big enough to support people and businesses while they're being asked to stay home. So I think that's definitely the biggest risk, and it's a real risk. And then even kind of more medium term, if that sentiment continues, where there's this feeling like, oh no, we have to pay back these big debts that have been run up as a result of COVID. So I think there's a chance for kind of that risk extending into the medium term. So hopefully, there's always politics involved, but I think more than ever, this the connection between policy and markets is probably bigger than ever right now. And on the fiscal side, I know market pundits and a lot of the newsletters and stuff like to focus on the Fed, but I think the real kind of potential swing point is on the fiscal side.
So, would you agree that the attitude towards the fiscal deficits has changed? Like, do you think the deficits hawks are going to have their day in the sun, and that we're going to return to trying to balance budgets?
I don't know. I'm hopeful that it's not the case. We're seeing already signs of it. I don't know if you saw that. There was a story last week. It was the head of Biden's transition team was talking about the pantry is going to be bare if they win the election.
Yeah, I saw that. I saw that. Scary stuff.
It's scary stuff, and it's unfortunate that I guess for them it's unfortunate if they're trying to get elected that they're talking that way, because I think an easier sell is to tell people we're not going to cut off your income that you desperately need right now, or at least hint at it. So politically, I think it's a very bad move, and it just doesn't make any sense from an economic perspective. So you see signs of already talk of like, oh, we're going to have to tighten our belts in the future. I guess on the flip side, on the more positive side, is I think public awareness has increased a lot in terms of what is possible with fiscal,
right,
as a result of COVID. So as the economy was going to be shut down, and all of a sudden you had this big, massive response. And I think it got people wondering and asking, like, where is all this money coming from? And realizing it's not coming from, it's not like the Canadian government found a stash of old surpluses in some silo outside of Ottawa and then thought, oh, we can dip into this now. They just, they needed to spend, and they just spent. And I think people kind of saw that, and that they were spending without their taxes going up. And so I think there's this growing recognition of the power that goes along with a government that creates its own currency. And I'm even noticing it kind of anecdotally with friends, even people who aren't in finance or economics, and they just seem to have a greater understanding of that whole aspect.
Right. And on that note, there's always money for war was always the kind of pushback that the MMTers made when the fiscal hawks tried to tell them that they couldn't do something. And now people are realizing that although COVID wasn't a war, it made them realize that the government can, as you say, spend and create money. Now, let's think about this for a second. The hard money Austrians will tell us that this is going to end badly. This is going to create inflation. What would you say to them? What sort of reassurances would you give to the people that think this is going to end in tears?
I guess one of the first things I would point to is just the fact that Canada, as an example, has been in a net debt position for, I guess, almost 200 years or whatever it is. And so that's the first thing I point off is that the debt there's no reason to expect it to get paid off.
Right.
And history provides great support for that. So when you think about it, when the government's running these deficits, and this is kind of getting into MMT stuff now, they're adding assets to people's accounts. So when they run a deficit, they're adding more assets than they're taking away. So they're spending, say, to build a bridge for $100 and then taking away $90 in taxes and leaving $10 out there in people's accounts. And then whether they can turn those $10 from bank deposits into treasuries if they decide to issue bonds, which they generally do. So then we start to realize when the government's running those deficits and building up the debt, they're really just adding more and more assets to people's accounts. And then when we think about passing them into the future, we always talk about it as passing some kind of burden to future generations. But when you really think about it, we're passing assets to future generations. They're assets now. We have bonds on the asset side of our balance sheets. All the big pensions do. And then they're an asset today. They're an asset tomorrow. They're an asset in 10 years. And then when they come due, if it's the debt of a currency issuer, all the currency issuer does is change that what's basically a savings account with a government to a checking account. And so those assets don't disappear when they pay off the debt. They're still there. They just change form from a treasury to a bank deposit. Now the question becomes, there's self-imposed kind of, I guess, rules on the treasury not overdrawing their account at the Fed.
Right.
So then the question becomes, how do they replenish their account after they've paid off the bond? There's three ways they can do it. One is you can tax and drain assets from the economy. But
Right.
as I said, if you look at history, that's not the route we've chosen for hundreds of years.
Right.
And the other one is you can just roll over the debt, which is it's most common and what you'd expect. And then in a worst case scenario, you could just have the Fed or the central bank buy new debt. If they're going to roll it over and the private sector is not buying it, then the government or the central bank could buy it. And then, so I think that's where people think, oh no, that could be inflationary. But again, the path that's the most common is rolling it over. And then even if they did do that QE-ish monetization type option, the last one, there's a thought of it being inflationary. But even looking at, say, Canada now, the Bank of Canada has for decades bought 20% of Government of Canada bonds at auction. In the wake of COVID, as part of the response, they increased that to 40%, up to 40%. And as you can see, just looking around, we don't have rampant inflation. The Canadian dollar is not crashing. And so I think
Japan's a perfect example as well. How long have we been listening to the people tell us that QE was going to cause just hyperinflation in Japan? And I don't know. I've been hearing this song and dance for what, a decade and a half.
Yeah,
and yet they've been suffering. In fact, they actually had some bouts with deflation, not in hyperinflation, right?
yeah, and exactly. And I think a big part of that is the misunderstanding of what reserves are. So that's, when the central bank is buying assets, it's exchanging them for reserves. And I think people think of reserves as money that can float into the economy or it's lent out. And that's, I think, one of the key things where Austrians and others get it wrong is that it's that money exists in its own little loop, in its little closed system, just among, say, in the U.S. example, among members of the Fed system, and it
Right.
never leaves. And banks don't lend them out, so
Yeah.
there's no real impetus for inflation resulting from those central bank asset purchases.
Right. But okay, so I'm going to play a little bit of devil's advocate here. And you have said numerous times you are not a traditional MMT advocate. You understand the system. You think there's lots of positive things that come from understanding it and using it in your policy, or sorry, in your actual thinking and your kind of conclusions. But it's not like you are a true MMTer. But one of the things that you just rightfully pointed out earlier in our discussion was that you mentioned that there's been a realization from the public that the government can create money out of thin air. And I would agree with you as well. I think that there's been a wholesale change in people's attitudes about how easy it is to make money. And I one of the reasons that I believe that MMT has not caught on in terms of people understanding this is that it wasn't in people's or the elites' interest to have people understand how easy it is to create money, because if they do, they will demand everything and it will be abused. And one of the things that I kind of say numerous times is that, yes, once the public realizes how easy it is to make spend money into existence, they are going to abuse it. But just like they abuse monetarism, like we have minus 100 basis points in in Europe. Don't tell me that they didn't abuse monetarism there. And I just argue that this is actually a better system to abuse than trying to fix everything with lower and lower rates. But an MMTer will tell us that no, they're going to be able to control this inflation. So I'm going to step back and say, what is your thought? Are they going to be able to create, if we do have a situation where we start spending money into existence and we embrace this policy, will we be able to control it, or is that the big scare for the markets going forward?
I think, well, first of all, before we get to a point where we see inflation pick up, I think there's a lot of room there still, especially now with a lot of capacity being offline. That can
do you really think that? Because I actually feel like we're already seeing signs of inflation ticking up.
I think in certain areas where demand hasn't changed, so food, people still need food, and it might be harder to ship things or more expensive to get things to a restaurant or whatever, or to run the restaurant. So I think we're seeing it in certain areas.
But wouldn't you say that? Sorry, I didn't mean to interrupt, David. But wouldn't you say like things like lumber exploding higher?
Yeah, and I think that might be driven by what's going on in housing and stuff like that too. But so again, I think it's isolated. I think it's hard to expect wages to go up in an environment like this, and that's one of the big drivers. But I'm not saying, like, I'm in the camp with you that I think inflation directionally is going higher, but I think our definition of high inflation has changed. So I would consider, and even going up to kind of anything over 3, 4, I consider that high inflation these days, whereas in the past, that would have been quite low inflation. So I think directionally, that's, I'd be in the inflation versus deflation camp. I'd be on the inflation side.
Okay.
But I do think there's room to get there before we get there. But even once we do, I will say that I think so. When you pointed out earlier, like, I don't consider myself an MMTer, and it's not anything against MMT. I don't put a label on myself for any kind of group or camp, and I just try to, my goal is to try and get it as right as I can, and whether it comes from an Austrian view or whatever, and pieces from all these different areas. And so, but it's just in my efforts to try and figure out the way things actually work, I found that I probably agree with MMT on like 95% of the things
Right.
and the big ones as well. One area where I think there needs to be more work is exactly on that inflation piece. And it's hard to expect politicians to be the ones to pull back the reins when, there's signs of inflation. So I think there has to be changes in terms of the tools that are given to the people that are in charge of monitoring and managing inflation. So the MMTers will talk about job guarantee,
Right.
which I think could work, but I think it's something that would take a lot of time and effort and study and all that to get to. I think there's things in the near term that could make it more possible. So one example, and I think again we've talked about this before, is kind of giving more fiscal type tools, things that actually add money or take away money from people's accounts, giving things like that to the central bankers. And so Bernanke, as an example, had written a piece years ago where he talked about giving Congress basically an account that they could spend out of, but the Fed would be responsible for the amount that's in that account based on their inflation outlook. So you're
Right.
kind of separating the politics from the inflation management. I think another thing that's possible is, so another way to get there is there's a guy, Eric Lonergan, on he's on Twitter and internet. I think he's great. He talked a lot about this kind of stuff, like a new way to conduct policy going forward. And one thing he talks about a lot is dual rates. They could do it now, basically in Europe, without changing rules and do it quickly. And then the idea there is you have one rate that you target for borrowing, another one for lending, and then you can set it so that because we think of lower rates as being stimulative, but as Warren Moser would like to point out, that's taking interest income away from people, from savers.
Right.
So anytime you benefit borrowers, you're hurting savers basically.
Yeah.
So by splitting those into two separate things, you can kind of benefit savers and borrowers at the same time. So that's another example of a tool where I think it's something central banks can do, and it actually gives them kind of a line into adding or taking away accounts, which are numbers from accounts, which they can't really do right now.
Right. So David,
But so
sorry,
I feel like it's something that I consider it, I wouldn't say a weakness of the MMT perspective, but it's something that is often not talked about in as much detail as it should be.
Right. So I could hear all the groans from our hard money listeners when you said that you wanted to give the central banks even more power. And let's just kind of talk about that, though, and explain to them what it is, because I think that if they actually understood it, maybe, or they gave it a chance, that they might actually find it is a better way to do it. And let's just take, for example, the great financial crisis. We had, as I explained before, we had a period there where the government was pulling back on spending while the private sector was also pulling back on spending. So we had both the private and the public sector pulling back on spending in a credit delevering, right? And so this obviously made the economy very weak. And what Bernanke tried to do was, he was the only guy in town, and all he could end up doing was lowering rates and doing more QE and all sorts of crazy stuff like that. And meanwhile, he was begging everyone, all the governments, to go and to spend, right? He was begging them. And I would argue that this has actually been one big change on the current policy response, is that Powell understood this. Powell got out ahead and said, and he's been very clear in this message, we can only do so much. You guys need to do it. And the government has gone and started to spend. But most times governments, once they start spending, it's tough for them to take it back. And what's that line? There's a line that's nothing is as permanent as a temporary government subsidy. And your idea, just to display this in full, is the Federal Reserve would, in essence, give the government money to spend that they would then pull back when inflation reared its head. Is that correct? In essence, kind of correct?
Basically, yeah. So that's the Bernanke idea. And he talked about it more as being something that would be used kind of in that example you gave where things were really bad. And I don't know if he thought of it necessarily as something they use kind of daily, but That is the idea. It's once you recognize that the central bank currently, when we, even though we talk about them printing money, they're not printing money in a way that adds anything to the economy or to people's accounts again. All they're doing is it can only exchange a certain kind of money for another asset. And so this is a way to give that ability to actually add numbers to people's accounts to the central bank.
Why don't we explain that a little bit more, just so people really understand? Like when they talk about one of my big pet peeves is when they talk about the stimulus, how they put together the Federal Reserve stimulus program with the government fiscal stimulus. And I always say they're completely different. The Federal Reserve lends, the government spends. Right? Is that a good way of thinking about it?
Yeah.
Right.
Central bank lends or just swaps assets. So yeah, that's
right.
Like QE would be, if they're just buying something, they're not giving something away, they're exchanging it for something else, or else they're lending.
Right. So they print these things out of, like, they buy these assets, and everyone thinks that that's money that's going into the system, into the real economy, but it doesn't. What happens to it? So the government buys the bond, they pay JP Morgan. What does JP Morgan do with that money? Like, explain why that doesn't get out into the real economy.
Again, because all the Fed is doing is exchanging, say JP Morgan had a treasury, the Fed's exchanging it for reserves. And again, it's that whole idea that reserves exist in a closed loop that's only used to settle payments amongst Fed members themselves. So it doesn't leak out, it doesn't get lent out. And so, we see these charts showing the Fed balance sheet blowing up, and it's because they're taking one kind of asset away and giving those reserves to people. So when people see charts with reserves ballooning, they think, oh man, one day that's going to leak out and it's going to cause inflation. But again, it exists as a closed loop. It just never happens. And then just one more thing, it's just those charts, they always show the growth of the assets on the central bank's balance sheet, but they never really show the flip side. There's always a flip side, that there's an equal decline of some other asset on everyone else's balance sheet.
Right. So let's talk a little bit about reserves, because like this is kind of one of my pet peeves with the people that deal with this sort of things. They talk about, oh no, it's a closed loop and it's these reserves. But last I checked, the government, the Federal Reserve buys those bonds from JP Morgan and pays them dollars, do they not? So what exactly is the difference between like a trade in dollars and a trade in reserves? And I think explaining that might help.
Well, I think dollars can be used by anyone to buy other things. But again, when the Fed buys from, say, a customer at JP Morgan's, that it's the customer's deposits are going up, but from in JP Morgan's perspective, it's the coinciding thing on their balance sheet would be reserves going up. So the deposits of their customer being on their liability side, the reserves being on the asset side. So the reserves again are still just for JP Morgan and they're closed. But I think what you might be thinking about is that increase of deposits on the person that sold the bond,
right?
The customer. And so this goes back to a thing where it's kind of like it's comparing the effect of treasuries. If I held a treasury and I held an equivalent amount of bank deposits, it doesn't really change my behavior. I think this is what you're getting at, is that the fact that there's more deposits out there and fewer treasuries, I think is perceived as being more inflationary.
Right.
But it's still the same amount of assets that are out there.
Well, I guess sorry to interrupt. I was going to say, one of the things that I like to explain to people is that the JP Morgan does not make loans based upon how many reserves they have on their balance sheet. Like when they go and sell that bond to the Federal Reserve and have more reserves, they don't instantly go out and make a loan. They were never reserve constrained. They made loans against their balance sheet, against their capital, and against the amount of willing borrowers. The fact that the Federal Reserve came and bought a bond from them changes nothing in their willingness to make loans.
Right.
But listen, I would like to investigate this kind of go down this road that I think you're headed down, which is something where you and I have disagreed on in the past. And it's the fact that I contend, and I must admit, I'm a little zero hedge-ish this way, that QE is stock market positive. And I know that that really it shouldn't be, but yet I just can't help but think it is. Why don't you walk me through? Was that where you were going with this discussion about how many it's changing the composition of the amount of assets that are out there, and then therefore that changes the behavior of investors?
Yeah, I think we agree more than you might think on that.
Okay.
In that I think QE potentially impacts the stock market, but if it does, it's because of the psychological effect and that feeling that, oh, the Fed's got our back, or the Fed's printing money. And then when people start seeing headlines like that, whether they know what's going on behind the scenes or the mechanics, it sounds bullish. Everyone else is talking bullish, so stocks will probably go up as a result. But I think where we differ is on the mechanic. Like, I don't think there's a mechanical connection. There's nothing.
But what about this idea? There's a certain amount of investable assets out there, and then there's a certain amount of money to be invested at any one time. If the Federal Reserve is pulling, like buying and holding on their balance sheet a certain portion of investable assets, doesn't that decrease the supply? And therefore, through a mechanism, like, I guess the person that owns the treasury now sells it and buys an agency. The person that owns the agency sells it and buys a corporate, and so on and so on. And then eventually everyone's headed out the risk curve because there's less investable assets out there.
I think where maybe I'm thinking differently is that I still think there's the same amount of investable assets out there.
Okay.
Maybe there's fewer tradable assets. So I don't know if you can call them investable assets, but if I own a treasury and I sell it to the Fed, there's now the same amount of assets again, but instead of owning an asset that's backed by the power of the government to raise money, I now have a bank account that's backed by the Fed, basically through like the banks being backed by the Fed. So it's the same number of assets. It's just the first one I had something that I could have traded, I could have repoed.
But very few people will leave their money in the bank. So maybe the amount of investable assets is the same, yet because people will want to leave it in cash, which is in essence what you're saying, it pushes everyone out the risk curve.
Yeah, but I think, say for example, I used to work at a big pension. If, say, a bond matured, I didn't work in that area, but I presume they don't think, oh, now we have this cash, let's go buy some private equity. They think this is our allocation to safe assets or income generating assets. Let's buy another income generating asset. Just because something becomes a deposit isn't going to change your decision of whether that's going to be in the risky bucket or the risk-free bucket. So to me, I think like more equivalent, I would think a GIC, not tradable, but it's a lot more equivalent to a treasury than, say, equities.
Okay.
And I made the decision already, I'm going to have a certain allocation, risky versus risk-free, and I would put that bank deposit in the risk-free type bucket because it's backed by the Fed.
So I think we'll have to agree to disagree, because I as a trader who sat and watched my screens for so long, I completely think that it causes it. And maybe it is just all in our minds. Maybe it's enough idiots like me believing that it causes it, but it causes it. So
I'll say one more thing. I believe it. And again, I agree, but I think it's the psychological aspect. And I will say, mechanically, I would think, if anything, taking treasuries away and replacing them with deposits is actually potentially liquidity draining, because again, those treasuries are the most sought after liquid repoable asset in the world. And there's a whole collateral based money system on top of them. And if you start taking that collateral away, you're taking away from the potential of that system. And you can't build that kind of system on a bunch of deposits.
Right.
Deposits in my name, I can't trade it with someone. So I think, if anything, mechanically, it's potentially actually has the opposite effect. But then again, the psychological stuff is what matters for markets.
So let's go on. We're taping this on Wednesday afternoon, and tomorrow we're going to have Jerome Powell giving us his what is it? They're in what's the name of the place where they're going?
Virtual Jackson Hole?
Yeah, the virtual Jackson Hole. That's right. I forgot. I was thinking of Wyoming. But anyways, they're having their virtual Jackson Hole. A lot of times that this has been the place where central banks have used it to trot out new ideas and new policies. I think Ben Bernanke did a famous announcement of one of his QEs there. One of the things that I've been amazed at is how quick the market has been to assume that the Fed is going to do yield curve control. I thought it's insane. We're so far away. Bonds are basically scraping along all-time low yields, yet everyone's screaming for yield curve control. I think we're a long way away. What do you think?
I would agree, and I think there's potential for it at some point in the future. But to me, I view it more as something that would be done if they thought yields were too high.
Right.
You start getting into the average interest kind of payments on outstanding debt versus growth. If you start getting into that kind of dynamic, that's where, in a pinch, the Fed could always suppress the rate. And, they did it after World War II. So I think, we're not anywhere close to, I don't know who would think that yields are too high necessarily, right? Especially, when it comes to that debt dynamic. So I think it's something we could see, but it's more something that it comes at a point when yields are actually moving up a lot, not just doing what they're doing now.
Why do you think the market is clamoring for it so badly?
I think it fits in with that whole kind of obsession with central banking and monetary policy and feeling like it's the be all and end all. And meanwhile, you got fiscal policy over there, and everyone's looking at the shiny knives being waved about by the shiny trinkets by the central bankers, and then maybe getting kneed in the groin by Congress not coming to a deal. So everyone should be more focused on that. And I think it kind of fits with that, is it's this obsession with central bank policy and not even necessarily understanding how it might help markets. Just it's like, oh, the Fed's doing something. Oh yeah, they're printing money. Oh, they're buying everything. It's just, it kind of fits in that camp, I think.
So they're looking at it and they're thinking it'll actually be stimulative.
I think so.
Right, and it's going to be anything but. It's not going to change it's not going to change anyone's behavior of yield curve control.
No, and I'm more extreme in my views than you, but I think a lot of central bank policy fits with that. Like, people think, again, it drives everything, but when you kind of follow the dollars, it's the fiscal piece that matters more, I think.
So
actually, this reminds me of one thing I miss about work is being able to talk to, kind of, especially given where I used to work, you could pick up the phone and talk to whoever you want, basically, in the macro world, and having access to great thinkers. And I think it was Seth Carpenter at UBS. He used to work at Fed and Treasury, and he was saying he'd always kind of tell clients, like, we have Treasury funding update coming out today, whatever, and like, no one wanted to talk about it, and he was saying that's where you should be looking. Or as another example, when it was, I think we've talked about this before, Glenn Haddon, he presented at the first MMT conference, and he's a local Toronto guy, and then he was head of rates globally at Morgan Stanley and at Goldman, I believe. And then he presented there. And then one of the things he said too is, there's this obsession with QE and central banking. And so, when we talked about QE, it was all about taking duration out of the market. But then Treasury was putting it right back in at an even greater rate. And no one's looking at Treasury, and everyone's just like obsessed with the Fed stuff. So that's another example of,
what do you mean that the Treasury was issuing bonds at a faster pace than the Fed was buying them, and so therefore there was
at
actually
a faster pace, and I think going out the curve more and more. And I think that was like, so the average maturity was increasing, but everyone was just, all the stories were all about, QE is taking duration out of the market and all that kind of stuff. And if you really care about duration and the amount of bonds that are out there, you should be looking at what Treasury's doing, not at what the Fed's doing.
That's a great point. Let's kind of look into that idea that you said something to the effect that I'm more extreme, meaning you are more extreme in your views of how little central banks matter. I've kind of thought about this a long time and thought to myself, why are we obsessed with it so much? And I've come to the conclusion that when we had a period when the private sector could be induced to actually create money through bank lending, and when monetarism worked, it was the be all and end all, and it actually was more important. And this is my pushback to MMT, is that I don't think that they take into account the private sector, the private side of the equation enough. I just contend that it's when you get into a situation where the balance sheets of all these private sectors are so strained and so overburdened, and we hit the zero bound, that's when basically monetarism fails. But would you agree with that, or do you think that even, like, let's say in the 80s and 90s, we were overly concerned about what the central banks were doing, and we should have been looking more at what the fiscal side of the equation was?
No, I think that's fair, because it was a different paradigm, and once you got to targeting rates, the quantity became, monopolists can control either price or quantity.
Right.
And then once they chose price, the quantity just was a function of the economy, basically what the economy was demanding.
Right.
But so before we got to that, the quantities mattered more, so I could understand why people would be focused on that. So I think I hadn't really thought about that before, but that seems fair, and it kind of fits, I think, too, with the fiscal side and how the way the conventional view is formed is valid if we lived in the gold standard era. And so you can understand why people think that way. It's just should have stopped thinking that way once we went off the gold standard in 71. And I would say the similar thing for central banking. I guess, I don't know if that answers your question.
No. Well, I just find it interesting because I saw an interview with Warren Mosler, and he argued that we think that the central banks are controlling everything. And he said it's kind of like when you give your child a pretend steering wheel and put them in the back of the car and tell them that they're driving the car. And they might think they are, but the reality is that the parent sitting in the front is driving the car. And although I am sympathetic to that argument now, I think that during a period when private sector is there and responding to the changes in interest rates, that the central bank policy is all important.
I guess that's a whole, like, fitting with the MMT and the broader kind of post-Keynesian endogenous money camp. There's a lot of skepticism in that world, and I would tend to agree with it on the power of interest rates in influencing investment decision making. And they focus more on, say, when it comes to, it's more about the uncertainty around cash flows in the future. It matters more than financing costs. And I think Nathan Tankus, he just wrote about it 2 days ago, where exactly this topic on the sensitivity of investment to rates. And it's something where he talked about corporate hurdle rates being a lot higher than anywhere close to discount rates, policy discount rates. So there's this cushion of like 17 percentage points generally. And then also those hurdle rates don't change. So then, it's when it comes to actual investment decision making, that interest thing isn't really making much of a difference.
Right. So let's just explain that a little bit more. Like the fact that you're a company and you can go out and borrow money for your plant to make more widgets, whether you're borrowing at 3 or 4% is as important as whether you actually have customers to buy your widgets. Because the reality is that if nobody's there to buy your widgets, your financing is the least of your worries because you have basically a plant that's useless.
Exactly. And I often say, even an interest or a loan at 0% becomes very expensive if you take that money and put it, down the toilet or into a plant that generates no revenue, because now you have to pay the principal back, and then at the end of it, you're out your 100% of your principal. Uh, so that's so it's more about confidence in those cash flows, and even if you look, say you're a CFO and you have a project that the expected return on it is some great potential payoff, but there is a 20% chance at zero, then you're not necessarily going to take that chance because of your career risk.
Right.
So that's, again, going back to uncertainty around cash flows and whether people are going to walk into your store and buy stuff. That matters a lot more than interest rates. And then even on the consumer side, we always think about borrowing, but interest is a big source of income, particularly for people that have a lot of assets. So anytime you're decreasing interest rates, you're taking income away from people as well. And I think it was Goldman a few years ago did a piece on kind of the breakdown of households and how whether they're kind of net collectors or payers of interest, and on net they're collectors. So overall, households would be hurt by lower and lower rates when it comes to kind of income versus expenditure piece.
Right.
I just want to go back a few things before we leave
Sure.
it, and it kind of goes to where you were talking about MMT, and I think maybe you were talking about the private balance sheets and how there's not enough attention on it.
Right.
Is that right? Is that
Well, I
what
would
you were
argue
thinking?
that the private balance sheets were important when they had the ability to borrow money, or were more sensitive and more willing to borrow money based upon interest rate changes. And I would argue that the reason that every economic recession, the subsequent rally in the economy or a subsequent advance in the economy always plateaued at a new lower interest rate. And that would be because there's more and more debt each time, and it becomes more sensitive to it. So we've gone, and each time we've piled more debt on, and therefore the economy stops quicker and is less responsive to changes in interest rates. And then we lower it again, and then we try to fix it by lowering rates, and then the economy gets going. But then again, it plateaus at an even lower rate until we hit zero. And then at zero, the way that we know the world changes, and no matter what you do, you can't convince the private sector to borrow anymore. And that is when the realization that fiscal is how you have to do it kicks in.
Mm-hmm. But yeah, I would agree completely that that whole dynamic is a function of the fact that we've been so reliant on this basically one policy tool.
Yeah.
So it's something that a greater use of fiscal or a fiscal type tool would, I think, help alleviate.
Well, I 100% agree. Like, think back to the great financial crisis. I remember when they did the first quantitative easing and they were coming out to buy bonds. Bonds were, 30-year was trading at 1.25 or some stupid number, and they're coming out to buy more bonds. And I'm saying, why are they buying bonds at this point? They should be issuing bonds and putting people to work. Putting fiber to everyone's home or doing something like that. This isn't going to do squat in terms of actually helping the economy. And I would argue that we finally woken up to this fact, and that the world has changed, and we realize that quantitative easing and buying this stuff and monetarism in general has failed, or it's reached its limit. And now we have MMT, or I don't know if MMT is the right word. The realization that fiscal is an important part is finally kicking in, I would argue.
Yeah, I agree. And as we talked about at the beginning, I think COVID has really highlighted that. And you can only imagine what the counterfactual would be like if fiscal just went on its business as usual. The world would look a lot different right now. And I think that it really is a real potential turning point, hopefully. And then not even just for economy and the real economy, but maintaining all these financial contracts and kind of providing a bridge until real revenues come back or real incomes come back, and then you can assume the debt again on your own. But I think it also shows too, it's not just that kind of the help for the economy. But again, like we talked about what's going on with stocks, and that wouldn't be happening if we didn't have this fiscal response.
Right. If we tried to
and I
fix
think-
it all with monetarism and with more QE, it wouldn't have worked.
Yeah, exactly. And it's one thing that I think people miss is there were actually articles from kind of serious economic journals acting somehow surprised that incomes were helped by the fiscal response. And I honestly, I don't understand that. And I think, it seems pretty obvious. You give people money, they can either spend it at a store, but you're not allowed to go to the store, or, you can't go to the restaurant. So you either, spend it where you need to, or you pay down debt, or you buy assets. So, it seemed pretty obvious. And I think it's probably stuff we talked about right after the response came out is, the money's got to go somewhere. And I think that this recent example really kind of shows the power of fiscal. Another thing I think about too is, you maybe have seen these charts that show personal income in the US. The growth rate of it, I think, reached, I don't know if it's all-time highs on a year-on-year basis, but it's pretty amazing to think we're in this, close to a complete shutdown, and incomes are just growing at that rate. And so again, it just shows the power of fiscal.
So it has been amazing, and it's strange because when you came on a year ago and started talking about MMT, you were like the quack that believed in this crazy theory, or at least understood this crazy theory. And now,
I'm still crazy for other reasons.
Would you not argue that the attitude towards the MMT has changed, like the critiques of it has changed?
I would say definitely yes. So even just speaking anecdotally, so away from kind of the more formal critiques, as I mentioned earlier, I have friends talking about it. Even professionally, I've been asked to write related articles or this kind of money theme, write some pieces for something called the Canadian Investment Review, and presenting on MMT type concepts for this group called the Global Risk Institute. So these are like institutional investors in serious institutions that are talking about it, and they want their members to hear about it, which I don't think would have happened a year ago.
Right.
And I feel like it's part of this kind of perfect storm almost, where we had the COVID response, which really highlighted things. And then at the same time, you had Stephanie Kelton's book coming out.
Okay.
And, and it's written in a very kind of user-friendly, introducing new concepts kind of way. So you put the two together, and so it's created this like a very ripe environment for people discussing kind of new ways of doing things, or actually old ways that have come back. And then, like you said, the critiques, like I've noticed they're changing from one thing we, kind of talking about, oh, these guys are all crazy, nothing to see here. And then more recently, it's like, oh, there's nothing new here. These are old ideas. And so I think it shows these kind of like shifting goalposts, and almost like the more mainstream conventional thinkers kind of giving some ground. And by saying, oh, there's nothing new here, it's like they're trying to say like, oh, we knew all along. I will say personally, I went to grad school for economics. I worked in industry for 15 years or 20 years before I heard any of these ideas.
Right.
So I don't know how they're saying there's nothing new here. I know the ideas were old. It's just they didn't teach us in school. No one talked about it. So how's that very useful? And also I think like even if there's nothing new here, I don't try and learn about economics or markets to try and find new things. I'm trying to find basically the way things work, and again, help me get it right. So if there's some ideas that have been around for a long time that help me get it right, I don't care whether they're new or not. And I don't know why that's viewed as a critique. I think about things like, oh, someone says, oh, you should buy this stock. It looks really cheap relative to fundamentals. And I say, oh, I don't know. Warren Buffett's been saying stuff like that for years. I'm not going to participate in an old idea like that. Like, it just, if it's going to make you money, then buy it, right? I don't care if it's an old idea, a new
Well,
idea.
having said
comes
that,
from,
in this day and age, a value stock's not going to go up anyways.
well, no, that example.
Yeah, you picked a bad example.
I should have talked about Davy Day Trader.
That's right. You should have. One of the things you mentioned, Stephanie Kelton's book. Did you get through it? What do you think?
I did. I liked it. I think it's great. I think it's, as I mentioned, it's written for kind of a mainstream audience, and it's introducing concepts that are not necessarily easy to convey. So I think it's a very hard job to do. And I know, speaking personally, I've tried to convey these ideas to people that are in the industry and are around them, which actually might make it harder sometimes. I like the way there's political aspects to it, which, when it comes to particular policy proposals, so you get kind of that stuff, which I'm not commenting on, but I just like the way that there were times when she was willing to, she wasn't necessarily picking teams. So there's times when she criticized like Obama and things.
Yeah, she was. I've seen her do that numerous times, because let's face it, he was a deficit hawk. And this is back to what I'm worried about with Biden, is the fact that he's from the same kind of school of thought.
Yeah, exactly. And she even, like, she had worked with Bernie Sanders, and she criticizes him, and there, I don't know if criticize is the right word, but highlights the fact that he's talked about the debt being a danger to his grandkids or our grandkids, and then she knocks Pelosi for PAYGO. So I like that aspect, where it's like, these days so much of the discussion is political, and the fact that she had her political issues, but that's, I think, more.
So she chose for the fiscal hawks, she chose to use Democratic examples to make it less partisan.
I think that was part of it. And I think that's a positive, just to try and get away from some of that divide. I think she did a really good job, I think, in explaining kind of what stuff we've talked about here, where there's this exclusive reliance on the Fed and central banking, and kind of laying out, when you cut through it all, the fact that their lever is ultimately unemployment, and they want a certain degree of unemployment, which, if you're someone unemployed sitting at home and you read that, I think it can have a pretty big impact, where you think, oh, the central bankers actually want me to not have a job. So I think.
Wait, I don't know this argument. Why don't you tell us what the kind of the Coles Notes version of this argument?
Basically, just that kind of inflation versus unemployment trade-off, and that the Phillips curve idea. So if inflation is running, inflation looks like it's running to, the idea that there's this natural rate of unemployment that is consistent with their inflation target. So if inflation looks like it's going to be running too hot, it means that unemployment is too low relative to that supposed natural rate. And that's kind of the framework that underlies a lot of the policy. It kind of gets lost in the weeds, because we're talking about rates all the time, but ultimately they're shifting rates because they're trying to induce some unemployment to then impact inflation.
I get it.
So I think
they couch it in that they want to slow down the economy, but reality, that means creating unemployment.
Exactly. And it's not them. That's the kind of standard economic mainstream model that's taught and used everywhere. And so I think she did a good job laying that out. In terms of weaknesses, I can understand why she might do this, but there's no real discussion of private money creation, which is how most money is created in the economy these days.
Right.
And that kind of, like, it's created through banks and extension of credit. So when a bank makes a loan, it's just creating money from thin air by adding deposits to your account, and then a loan on the other side of the balance sheet. But that, like, to me, that's almost like a whole separate book, and it's hard enough explaining the other stuff before you get into that. So I can understand why she wouldn't go down that road, but it's an important piece of the big puzzle, and it's not like she obviously.
I don't know. I kind of feel like all MMTers forget about that piece of the puzzle.
I think when it comes to private balance sheets, I think it's different than private money creation. I think more than anyone, like, I didn't, again, going back to that personal, going through economics courses for years, and that I didn't encounter this money creation aspect, that, like, endogenous money idea, until I figured it out on my own by reading people like Cullen, Roche, and Ed Harrison, people like that. So I think MMTers they're in that endogenous money camp. So I think they understand that part very well. I think where they do have a weakness is that kind of 3-sector model, the sectoral balances, and she talks about it in the book, where you have the government balance is the flip side of everyone else's balance,
Right.
and that everyone else is private sector plus foreign sector.
Okay.
And that's accounting correct, and it's a very helpful way to look at things. But I think there's room to go even deeper within the private sector and look at balance sheets across households and businesses, because the dynamic there is very important, and it kind of lies at the heart of the capitalist economy. And businesses exist basically to issue claims against their future production. So if they're not doing that, there's something wrong. So one way I like to think about it is, the private sector can look like they're saving in financial terms, but if they're doing it because households are going more and more into debt to buy stuff from the corporations, and the corporations are just like, leaving all that cash and money on their balance sheets, and they're not borrowing or using it to invest and build future production.
Right.
That's not a dynamic, but it still looks like, the private sector as a whole saving. Whereas, if you had the opposite dynamic where businesses were taking risks and borrowing, and then households were doing, they're borrowing, they're investing, they're paying people to build new plants to do things, and that allows households to save. Again, you're ending up with private sector might still have that same balance, but the distribution across businesses and households is very different, and it provides a very different view on the economy. And so by lumping them together, you miss all of that.
I get it. So your argument would be to separate on the private sector side of it businesses with consumers.
Exactly, and that's absolutely key. Like, just looking at growth, the productive side that I think people often think MMT misses because they're just talking about the money aspect and not the real investment and the real production. It would get picked up in there if you broke it down one more layer.
I get it. One of the things that we touched upon the partisan kind of complaint about MMT, and I thought it's funny because it's ended up being that the Republicans are actually under this president have been the most MMT-like that we've ever seen. Donald Trump, 8 years into an economic expansion, he cuts taxes. They ask him why he was cutting taxes and why he wants lower rates. He says, because there's no inflation, which at its heart is an MMT response, right? Because MMTers believe that there is no financial constraint. There's only a real resource constraint. One of the things that I think is kind of MMTers do themselves a disservice on, and some are better than others, but they have to emphasize that it doesn't, that the fiscal stimulus does not always have to mean government spending. It can just as easily be government cutting taxes. And I think Warren Mosler does a terrific job at explaining this and talking, why do you touch upon that and tell me where you stand on that, on this whole kind of taxes versus spending debate?
Yeah, I totally agree on that whole, just that perspective. And I was mentioning earlier, I've been doing presentations and webinars to various groups on this sort of thing. And one of the questions that always comes up is like, oh, isn't this just a green light for big government? And so one of the first things I always point out is big deficits in big government can be two different things. And you can have big deficits, as you say, through tax cuts, which is leaving more money with the private sector. So it's actually the opposite of big government.
Right.
So differentiating between the two, big government and big deficits, not necessarily being the same, one and the same. And I think you can get it, like you say, through taxes, through reducing taxes. But even if you went on the spending side, you can just do it by giving people money and then let them decide what they want to do with it. Do they want to invest? Do they want to?
Yeah. The funny thing about that is you say that, David, and you collectively hear the groans and the worries. Like you should see my old man. He anytime I start talking about this stuff, he's like, I can't tell you why you're wrong. I just know in my gut that this is just, I'm not comfortable with it. And anytime, I must say, when you start saying you could just give him money, I'm a little bit like my old man. I'm like, what?
Yeah. Well, you can I'm sure not taxing someone is accounting wise the same as giving them money. So if you told him, oh, what if the government said they're gonna, tax, $100 less last year or next year, that's the same as giving him $100. And then I'm guessing his perspective will change
Yeah, no, that's true.
because
That's a good point. You're right. But then why bother?
it's,
Why bother taxing and then giving it back to someone?
yeah, no, I know. It's just, but I mean, in terms of shaping the way people view things, and because often I find the people that are most vocal in terms of being against deficits are often, talking about private sector and, leave it up to private sector. But if you really want to leave it up to private sector, then you should like big deficits because it means you're giving or you're leaving more money with the private sector to let them figure out what they want to do with it.
Now that's a great
Right. So,
great line. Big
yeah. So
deficits mean that there's more money in the private sector for them to decide what to do with it. I like it, David. I like it.
exactly. Yeah. And you mentioned Warren Moser, and he brings up this example that he gave. I think he said the same speech on the same day, and one speech was to a Tea Party-ish type organization, and one was a labor union, and both groups totally loved the speech because the first group's thinking, oh wow, tax cuts, and the second group's thinking, oh, we're going to get some more money here for these programs. But it's they're kind of the same thing, especially when it comes to giving money. Once you start going down the road of government deciding, oh, we're going to build a bridge in this town, or we're going to, support this industry for research, that's a different. Now you're getting into the potential for the big government and making certain decisions that often have to be made outside of the private sector.
Right.
But if you go again, I would just say give money to people or don't tax them. It's basically the same thing.
Okay, so we're kind of getting towards the end of it. Let's take this back to the markets. What do you think the surprises might be in the coming year? Like, give me something that if you had to pick something that was like, oh, this is something nobody's expecting that might come to be.
Well, I guess on the negative side, but people might be expecting it, is that the fiscal, or maybe they're not expecting it if they don't realize how important the fiscal side is. But if we get a negative fiscal outcome in the U.S.,
right?
I think that would be potentially a pretty negative surprise because my personal base case is we're going to get something positive.
How much do you think that $1.5 trillion is enough?
I honestly, I haven't thought about a size, because so much it depends on how it's distributed and to who.
That's true. You're absolutely correct.
Form, and
you give $1.5 trillion to like the Jeff Bezos is not doing much to the real economy.
No, probably not.
You give $1.5 trillion to people like that are at the lower income, and it's like injecting heroin straight into the economy.
Yeah, exactly. I think another potential negative is, people worry about US dollar and stuff like that and often frame it and talk about big deficits and debt. But I think if you're going to get a real negative surprise in the US dollar, like more negative, it's waning confidence in institutions. And, it might be sound extreme, but some kind of constitutional crisis where election results aren't necessarily, accepted right away and things like that. I think that's where you get real risk to the status of the US dollar and things like that. That's not my base case, but I think that's
a potential. Well, let's actually talk about, we didn't talk about the US dollar at all. What is your base case of the US dollar?
I really don't have one. When I did my graduate work, I did it in international finance.
Yeah.
And even though I did that, I found I could never figure out currencies.
Well, that was probably the problem. That was probably the problem, is that you did your grad work in it.
I think it was. And I feel like it really is. It's one of those things that to me is, especially, US dollars, it's so much just about that risk on, risk off dynamic. So I think I'm in that kind of risk on camp, which would fit with continued weakness. I think the talk of how weak it's gotten is a bit overblown when you pan out and you look at kind of a longer term chart over kind of a multi-year framework. It's at the lower end of the channel, but on a panned out a lot further. There's nothing really kind of crazy going on.
Can I interrupt for a second?
But
Because actually, I want to ask you a quick question here. I've had a theory, and you could probably answer this better than a lot of people, that the big institutions that are allocating with timeframes in the years and the decade kind of timeframes, they are massively overweight U.S. assets. And even though everyone sits there and stares at the U.S. dollar and says that all these speculators are short, I argue that the big long-term money is hugely overweight, and that if they continue, it will be not just a year, but many years for them just to get back to bench. Do you think I'm out to lunch with that theory?
no, I would agree. I think that's probably true across various markets too.
Like you mean bond stocks, real estate,
bond stock.
like just everyone.
Yeah.
Well, of course, because it's and I contend that a big factor has been the fact that U.S. has been the only market with with positive real interest rates for the past 5 years.
Yeah, and I think too. Well, it's more kind of episodic, but after 08, 09, I know even though the Obama response could have been a lot better, it was relative to say Europe. The fiscal response was a lot bigger, and the fiscal response is bigger to Europe now, and Europe drives a lot of that, the U.S. dollar kind of direction. So to the extent you get, I guess, a better policy response in the U.S., you would continue to get. There's more reason to maintain that overweight that you're talking about.
Right.
I think just in terms of one more surprise,
Yeah.
is if equities keep going up.
Well, that's what I was expecting you to say. I set it up.
Yeah.
I was actually quite surprised when you gave me a negative response.
Yeah, no, I think that's very possible, and it kind of goes back to the fiscal piece. There's so much doubt in this whole rally, the whole way through. I think a lot of it is because people aren't connecting dots, not thinking the money's got to go somewhere. And again, not the Fed money, but the fiscal money. If you have nowhere to spend it, you're buying things about luxury cars being sold off lots, boats, second homes. So it's, people who have money and can't spend it somewhere and they can't go on their trips or whatever this year, they're just going to buy more assets. And then this whole thing about the breadth being poor and, it's all driven by 5 stocks and all that. I haven't gone down layers, but I kind of view that as a positive. It's become this kind of built-in hedge for stocks that do well during COVID and during the lockdown.
Yeah.
Relatively well. They're helping the market while the lockdown is happening, and then as things get better, you get everyone else going to participate more, and then those leaders aren't going to do as well. But I know it's framed as a negative and a big risk that everything's being driven by these 5 stocks. Again, I think that's a feature, not a bug.
So you think we can have a rotation that allows the market to propel the next leg higher?
I think so.
There
I think
you
it's
go.
possible. And I think that would be
that is definitely an out of consensus call. So David, before we leave you, let's just talk about something a little fun and stuff like that. You're a big music fan. You'll be in your COVID lair, just hanging out with your family and stuff. Have you got any good new music that you want to share?
I'll share one bit of news. Before I came on this call, a friend of mine sent an email saying there's a bunch of patios in Toronto open for live music now. So we might finally start getting back. I'd say my big summer listen has been a band called the Rose City Band.
The Rose City?
Rose City Band, yeah. Highly recommended. Kind of psych rock meets countrified Grateful Dead.
Okay.
It's fantastic. There's one guy who's the main guy in the group. He has 3 groups. One's kind of more Velvet Underground meets Black Sabbathy, and then one's more kind of 80s synthy poppy, and then this one's his kind of countrified rootsy one. So it's really good stuff. I don't know. I've been listening to what I always listen to mostly. A lot of Grateful Dead, Widespread Panic. So
I'm just googling here this Rose City guy. He kind of looks like an older version of you. With his COVID beard is even more unruly than yours.
Yeah. He might be younger. I'm not sure.
Anyways, David,
Yeah,
it's been a pleasure having you. For those who want to kind of reach out and chat with you or learn more about you, where should we point them?
Twitter is probably the best place. Junkbond2000 at Twitter. That's an old. I think I mentioned this last time. It was an old handle from either a wrestling chat group or a Widespread Panic music group chat group.
Yeah.
So I have that years later, or else LinkedIn. Those are two easiest places probably.
Great. Well, thanks a lot for coming on the show again, and we look forward to having you next year. Okay, Lena.
Yes.
Taylor.
I'm not going to be drinking. I'm not going to be drinking 11.5 beers today.
Yes.
That was awesome.
That was a hell of a ride.
All right. Well, what's on the menu here, Lena?
Today we're drinking Rorschach Brewing Company's Normopathy Pilsner.
All right, let's give this a try.
So brewed exclusively with German Pilsner malt, Normopathy Pilsner is dry and crisp with a present bitterness, herbal and floral notes with a bready malt backbone and hints of citrus and spice. That's a lot too.
Yeah, it's actually a really nice Pilsner.
It is.
We rarely have a clean tasting beer. Everything is all over the map when we're drinking these things, right? For the sponsors, this is about straight down the middle as you're going to get, right?
Super refreshing.
All right, let's do this. That's good. Kev, give us some disclaimer.
Okay. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much Huddle may include Herbalife Sting, Tesla rips and splits. Let's hope you're wearing sweatpants for that one. And you might even feel some average inflation from your Jackson Hole.
All right, that's awesome. That's awesome. All right, let's move on.
Okay, Patrick, talking charts. What do you got for us?
Oh, listen, let's just take a walk through the markets and see what's going on here. I mean,
I thought you were going to tell us to take a walk on the wild side there for a second.
Well, we could do that too, but listen, we both were asking whether there was going to be volatility that would return this weekend. We weren't wrong. I just thought it was going to be the downside, but what a rip. Like, I mean, this thing did not waste any time. 5 big consecutive up days. Well, big, but I mean, consistent up days. And this market is just edging right. It went right up to the 3,500 on the S&P. I mean, what a move. I think things are getting a little overextended here because when we go to the NASDAQ and we kind of take a look at what's actually happening on the tech, I mean, we really have this overextended market, and we have that catalyst. I mean, we'll talk more about Apple and Tesla a little bit later on, but what moves? I mean, this has been such a bullish move. It's. I mean, obviously, I'm speculating as to whether the imminent reversal is coming, but it certainly feels really frothy, doesn't it?
Oh, Patrick, the rip in the NASDAQ's just been one for the ages, right?
Yeah.
And I've been finally I've decided that it's time to take some stabs on the dark side. I can't help myself, and I think that we look back at this, we're going to say that this stock split. Remember, the stock split are both effective for Apple and Tesla come Monday morning. I think it's going to be a sell the news event, Patrick.
All right. Well, you know what? Let's talk more about that in our top 3. So let's what I wanted to also talk about is this breakdown in the dollar. And isn't that interesting the way, one of the things that I was talking about and looking at was this idea that if the dollar was going to be putting in some sort of a bottoming formation, I mean, it really needed to start showing this characteristic of rips to the upside and then being bought on dip. And there is no sign of that whatsoever on the Dixie. I mean, every time this thing tries to rally for a few days, they just hammer it down. You know, I think at some point the dollar is going to establish a bottom, but there is no sign in the price action for that imminently anyway.
Well, Patrick, I'm proud of you.
Really?
Yeah, well, at least you're admitting that technically it looks like garbage.
Well, I mean, the thing is, I can have my opinions, but the chart don't lie. I mean, this is ugly. But
you're gonna write your own song. Chart don't lie.
There you go. But what I wanted to though, let's talk a little Japan, bud. Like obviously Shinzo Abe is resigning.
Right.
And actually, let me put a U.S. dollar yen before you yell at me. The chart here on the U.S. dollar yen, clear breakdown in the U.S. dollar. I mean, this is where a lot of today's U.S. dollar selling is actually originating. Big reversal candle to the downside. Each one of these rallies more or less have failed in fib zones. And what's interesting is if we put on high volume nodes, the volume nodes, volume by price, you'll see a large amount of the volume the high volume node zones are all like in here, which is where the vast majority of the volume transacted, right? And the fact that the rally is continuously failing in those high volume nodes is generally can be concluded that it's a very distributive market still. I mean, the path of least resistance, no matter how much I want to be long the US dollar against the yen, it's not here right now. I mean, this opens the window for this to still remain weak. Question that I'm going to be looking for next week is this big red reversal candle in the yen open the window for a sequence of selling that lasts even a week or two, then we could see us print all the way back to those March lows. So, but that's definitely on the radar. And what's your take on what's going on in Japan?
Well, Patrick, first of all, this Talking Chart segment is just gold, solid gold, Jerry. The fact that I'm learning what a high volume node is, when you first said it, I thought it was something you picked up at a frat party, but obviously it's we're all learning something. It's great, great, and thank you for that insight. What about Japan? I think that I've been bullish on the yen for a long time, Patrick. I think it was a great way to hedge a potential anything going wrong in the stock market because it was going to usually risk off. It kind of moves, manifest themselves with higher yen. And not only that, I think that a lot of things are going right in Japan, and you could see a situation where the yen goes up either way. So I thought it was a win-win. In terms of Abe stepping down, I do think it introduces a lot of volatility into the situation. And I actually think that that's probably going to, it could very well usher in a risk-off move because oftentimes the yen has been a forebearer of kind of future financial moves or financial instrument moves.
Right.
So the fact that we're getting increased volatility with a stronger yen, I don't think is good for the stock market or financial assets in general.
What's interesting is that look how the Japanese Nikkei actually reacted to this, right? And what was interesting is that the chart actually looked pretty solid up until today's reversal, right? Like it was making higher highs, holding up along there. It almost looked like it was ready to go. And then this news announcement just creates this big sell day. Now, I always say one day doesn't make a new trend. If they have it back up to, 23,200 by tomorrow, then it really wasn't, by Monday, then it really was insignificant. But it is interesting that we got this big reversal day with that big yen move. So for the first time, Japan's worth watching for a long time. It's been a while since things started to actually get buzzing there. So I think that we have to start watching what's happening over there, right?
Sounds good, Patrick.
All right. Anyway, just very quickly, Canadian dollar broke yet again to a higher high, heading to that 77-cent level. Like almost all of these cross currencies is U.S. dollar down, and all of these currencies are moving. Like look at the way that the Aussie dollar broke out on the upside against the U.S. dollar. Like it really was a bad day for the dollar.
Well, Patrick, there's some argument that the average inflation targeting was a much bigger deal than people understood. And as the market has digested that and come to terms with it, it's resulted in a lot of U.S. dollar selling.
Yeah. It's definitely been the case. Nonetheless, notice just quickly putting on the natural gas contract here. This is just the September contract, but we can see here just continues to plug away. Just a few days of red candles look like it could roll over, and then boom, another green candle hammers it to a higher high. And that gas is working right now, and that continues to be the trend. What'll be interesting is we're approaching a lot of the previous highs. Up along these levels just north of 260. It'll be interesting to see if that overhead resistance starts to stall this, or whether or not this has got some real tailwind behind it that could give it punch it to like multi-year highs, right?
Patrick, I'm proud of you. You're trying to compete with Julie. Unfortunately, you're not doing as good a job. I need to know what Nathan the Lizard's doing. That's my my nat gas forecast.
There you go. so look at that failed prairie dog call by you and Chase. You know why? It stopped right in the fib zone, buddy. Maybe you can learn something.
You're talking about copper, by the way.
By the way, this is the copper chart. Yes, yeah. And so that flagging formation it paused, but you know what? Right now, if it breaks to a higher high, it's punching 310 to 315. This still remains a very bullish chart.
It can still now be a double meerkat formation.
It could be on an hourly chart. You have to break that right down for a double meerkat.
Well, we don't know yet. And so we won't get into another big discussion, but obviously it looks like you're correct in that we were premature in our prairie dog call.
Yeah. Hey, so what I also thought was really interesting is, have you been watching the grains? Like they're all running. Like
Patrick, don't goocher my trade. You didn't tell me you were going to talk about this.
Okay, well, I'm not long, so I'm not.
Oh, good. We're good.
So, like, if we were both long, I'm goochering. Like,
and
just
for those who don't know, I wrote about this on my letter, and Patrick is proving that he does not read my letter. So for anyone that
tell me that it was at the bottom of it, because like did I have to scroll down? Because I usually read like
Patrick,
I look at the picture. The picture's like
exactly.
Going to
You're
a Playboy,
just
right?
like exactly. That's my line. Everyone, I am the Playboy of financial newsletter writers. Everyone says they're subscribing for the articles. We all know they're just subscribing for the pictures.
Yeah, absolutely.
And you're proving it. You're proving it.
Oh yeah, no, I read the picture
and then you hit delete.
No. And then I get to that next paragraph, and then one more paragraph, and then my eyes start glazing over.
And the nerve of me to write more than 2 paragraphs with Patrick. He's like Trump. He needs it in like.
I need the executive summary. Just give me the bullets.
Right.
Just give me the bullets.
In big font.
Just tell me what to do. Tell me what to do.
So back to grains. But I love them, Patrick. I think they're headed higher. I think they're a great trade.
But what's interesting? Okay, so wheat. Hitting up along its July high. These are continuous contracts, right? So I don't know if you want me to look up individual month series, but corn. I think this actually was it rolling the contract. Right? I don't think that was an actual gap in the thing. That's just a continuous.
Why don't you pull up December corn and let's see what that looks like? Yep. Z is the contract month, in case you don't know there, but
that's right. So yeah,
no, you got 21. That's 21. You need 20. It's what happens when you let a stock trader trade commodities.
Yeah, like it's amateur hour here, right? So it wasn't the gap. So it was just they were rolling the contract. So we're approaching these highs on that December 2020 contract right over here, and so I mean usually. Just it pauses along highs. I mean, the support resistance is a typical place where there's some selling. But the pattern I want to see on all of these are all of them going to show the characteristics of being bought on dip. Usually the first surge higher is great, but it's about whether or not it becomes a legitimate trend, which is that buyers buying dips and pushing higher highs, and that trend emerges. So we have the first impulse, but I'm now trying to find out whether this is actually more than just one big surge, and whether this has actually got meat on the bone, where this could be like a 3 or 6 month trend. That's where there's real money to be made, right? And what's interesting though is the beans. They're running. Like look at soybean.
Yeah,
I mean,
I'm still upset you're talking about this.
Okay, done. We're changing the topic.
Well,
okay, so
you know what? Listen, for those that are listening, I never make any money on grains. I'm long. You should probably just sell them.
To be honest, this is definitely when I would be selling them, like fading the move for sure. They're overdone. You know what? I'll take that side. Now, listen, I'm not trying to say that they're bearish and going back down to their all-time low or their 2020 low. I'm just simply saying that after a couple weeks running like this, they're way overdue for a pause, right? And so I'll say that you should take a little off the table, buddy. Anyway,
I'm not. So therefore, you're probably going to be right, Patrick.
Anyway. We were talking about the fact that the inflation break-evens were up along their year high, right? On the 10s. And what's interesting is that when we look at the steepener, I'm going to focus just on 210s. Are you a 210 guy, or are you still doing the 530s?
No, I've gone out to the 530s. I like the crack cocaine of steepeners, so I'm way out. I'm on the longer end.
So nonetheless, big breakout. obviously it has to be driven by a bear steepener because they ain't taking their foot off of the front of the curve. The Fed isn't. And so really this is very much a play on inflation expectations, isn't it? Am I more or less characterizing that right?
I would agree with that.
Yeah. And so with this breakout, we're now edging toward the 2020 highs, or at least it looks like it's going to take a stab at them. And it'll be really interesting to see whether it develops, because when you put a really bigger picture, like a weekly chart, we've seen a considerable decline in the 2s10s to the point they inverted. And for the first time, we stopped making lower lows, bottoming formations. This entire consolidation. It's like the worst thing that could be on a chart for a bond bull.
I tend to agree with you, Patrick. And let's go back and let's look at 2009 to 2012. Let's have a look at what the curve did there.
Oh my God. You're getting so excited that you're wetting yourself.
Look at that, though.
I'm not even going to show it anymore. We shut it off. We're leaving this topic because otherwise you're going to get too excited. And but the point is, the steepener is worth watching. Now you're all excited about the 30-year one, right? I don't want. You know what? I'm going to leave that one alone. Because I don't want. I'm not going to goocher for you.
You don't know how to trade. You don't know how to trade that as a ratio spread. You don't know how to do shit like that. So therefore, I'm very confident you're not going to get long there.
Anyway, so let's talk about some of these international equities. And we'll wrap it up at that. I wanted to touch on just what's going on outside of you. Oh, first of all, let's talk about the Russell and the fact that. It really hasn't participated in the last surge. I mean, it looks like a flagging formation that could bullishly break. But, I mean, at this stage, with the NASDAQ and the S&P both making quite extended moves to the upside, the Russell has not bit at all to participate in this. I mean, at least I would have thought that it would have taken a stab for a double top retest along the high during this surge, and it can't even make that breakout. It's, I
think it's worse than that, Patrick. I've seen times during the day that it was actually negatively correlated with the Qs.
That makes no sense, buddy. I know that you're making a point that was evident, but I mean, just the idea that it was negatively correlated, I don't know how to wrap my head around. What would be the rationale behind that? I think it's just an anomaly.
I think it's the whole. Stay at home. The COVID's going to keep us locked in trade versus.
But why negative?
Because
so you think people are literally matching it long short?
I don't know, Patrick. It was so.
I think that's a pretty bold statement, buddy. Maybe you might.
It was crazy. It was crazy.
Well, listen,
at times.
I'll tell you what. Next week on the show, you can tell me whether that trend persists. Because if it does, then maybe you're onto something. But I think it might just have been like a 1 week anomaly or something. Okay. Anyway, well, let's report back to us in the charts next week. Okay?
Will do, boss.
All right, but I want to talk Europe. Like this can't. I mean, it's trying to break out, isn't able to break out in the Euro Stock 50, right? And then when you look at even, let's say, the London FTSE, looks like it's actually rolling over and weakening. And so this continue. Look at the way the Aussie market can break to a higher high. It feels like global equity is rolling over while we have the U.S. equities just ripping, right? And
same old, right?
No, for sure. The last chart I want to look, actually, I'll look at two more. We'll look at the KOSPI. And what's interesting about the KOSPI, obviously, it's a little bit weighted into semiconductors and other things in South Korea. But it was one of the hottest markets. It was ripping to the upside. Just gets hammered on a 5-day sell-off. And has been trying ever since to make a recovery, but so far this has been nothing but like a 50% retrace of the sell-off. This is actually a really important moment, like a break it or make it kind of moment. I mean, if KOSPI rolls over without making a higher high, then a whole bunch of technicians are going to start hammering it, and it hasn't broken yet, but it's worth watching. Yeah, it's going to be one to watch, and I'll tell you, like if the NASDAQ reverses next week after the split, that's that may be enough to create that imbalance. Maybe.
What's the final chart you got for us?
emerging markets. Like, what the heck's going on here? Now, this is obviously EM and US, but like, it doesn't seem like the emerging markets are worried about nothing.
Yeah. I love emerging markets over the long run. Like, you know me.
Well, yeah, okay. Like, yeah, if you want to give the fundamental thing of them being considerably cheaper than US
like
equity,
for my
then, yeah.
like for your retirement account, like what do you own for your retirement account? Nasdaq's like I'm not going to own that. I have like I'm basically my equity is almost 100%.
I own gold. I have 100% gold.
Buried in my backyard.
All right.
No.
Anyways,
the point is emerging
that
markets, they look great.
I think that you know what? I think that when the whole market gets hammered, this is not going to be left behind. I think that I feel that if we have a 10 to 15% market correction, because I don't want to get into this idea that we're going to have another monstrous crash or something, but we're overdue for the market to give something back. And whether it's a 10, 15% pullback, we'll find out. But what I'll make you a bet right now is that the emerging markets will be down in equal percentage points as the U.S. minimum.
Oh, really?
Yes.
Oh, okay.
I think the emerging markets will go. You want to make that bet?
Yeah, for sure. Okay, so
we're marking the highs of both, wherever the highs come in.
Yeah.
And at the end of the market correction, we're just going to compare the percentage drop from the high to the low.
Oh.
The highest price it traded to the lowest price it traded.
I'll do that trade all day
and the
long.
emerging market one will be equal to or greater than that of, we'll say, are you okay with the S&P or does it have to be the NASDAQ?
No, I'll give you the S&P.
Okay, done.
I'd rather have the
done.
NASDAQ.
What's the bet? What's the bet? What are we betting?
You name it.
Burger?
No,
Let's
you
just
name
bet
it.
Burger.
Burger. Okay.
Burger bet.
Okay.
I mean, I haven't had a good burger in a while. We've been all COVID locked up shit.
Okay.
Like, going out for a proper burger is going to be it's a good bet.
Yeah.
And more importantly, what we'll do is from a time frame perspective, we're going to make this bet that as soon as the market top comes in, because the market top may not come in imminently, right? We'll find out where.
Well, I know. I said that's the problem with our bet is that we could be waiting a long time before we get a correction.
Well, when we get, so here's the criteria. It's only good for this year, and the correction in the one has to be at least greater than 5% for us to measure.
Right,
so we're
but
not
the thing
going to
is,
measure.
we're going to count it like once one starts, then the other one counts from that point too, right? You can't wait for like
high to high. Low
no,
to
you
low.
can't do that, Patrick. That's bullshit.
Well, as long as they come within a reasonable period of time.
How about
Like,
just
okay,
this?
if-
How about just this? Let's just say 6 months from now.
No, I don't like that. No, I don't like that.
Okay. Anyways,
No,
your
no, it has to-
convoluted bet.
No, because the comment you wanted to take a bet on was I thought that the magnitude of the drop in the emerging markets would be equal to or greater than what we would get in the rest of the market.
Fine. We'll do your
that's
crazy technician magnitude of all.
and this allows me to manipulate the outcome.
Exactly. Okay.
Data mine it to make sure that it works out in my favor because I like burgers.
Yeah.
Right? Anyway, that's what we'll wrap it up for talking charts. So let's go on.
So, Patrick, this week in trading history, what do you have in store for us?
All right. Well, this week I want to go back to August 24th of 1857 for what's known as the Western Blizzard, or also as the Panic of 1857. So it seems like an apt time to discuss manias, panics, and some good old-fashioned transportation stocks here, Kev. So it was in the Panic of 1857. It was preceded by robust business expansion for the prior 7 years from 1850 to 1857. At the time, the hot stocks weren't electric cars and pharmaceutical companies, but in fact, railroads and land speculation. One of the inciting catalysts for the story was in 1853, the Crimean War that was fought between Russia and the alliance between the Ottoman Empire, the UK, and France. This created a shortage of grain in Europe, prompting an explosion in grain prices for North American producers supplying Europe. Once grains took off, the other commodities followed its trend into inflation. With all of this grain moving, railroads were the obvious direct beneficiary, right? And it became an incredibly crowded trade that led to a bubble in railroad stock prices, funding, and overexpansion. Suddenly, all of the new infrastructure also meant a booming in mining, in iron production, and farm machinery. Railroad track mileage went from 9,000 to 22,000 miles of track laid. The gold production increased 30%, and there was a doubling in cotton production. This extra gold also translated to banks issuing more money than ever, right? Because back then it was a gold standard, and so you needed a gold in order to print the banknotes. And so with no central bank to restrain them, remember, so the first bank of the United States and the second bank of the United States both were now shut down, and this was that window of time where the U.S. did not have any central bank running. And so the printing led to inflation, contributing to the appearance of even more prosperity. Railroads used the stock and bonds to floats to raise excess money and overexpand, overcapitalize, and underutilize everything. So, man, Kev, it's I'm having some serious FOMO just thinking about all of this. Like that must have been a hot time to be in trading, eh? And almost a little bit like today, right?
1857.
Yeah.
Are you asking me because I was there?
Because, you were there. Like, how was it? Right? No. Yeah. At the time, President James Buchanan. Did I say that right? Buchanan.
Now you got me.
Buchanan.
There you go. You got it.
Okay, it was quoted as saying, "No nation has ever before been embarrassed from too large a surplus in the treasury." So now here comes the turn. It was in 1856, the Crimean War ended. Both Europe and Russia experienced a good grain crop. Wheat prices in the American West dropped violently from $2.19 a bushel down to 80 cents, earning the nickname the Western Blizzard. It also helped that there was a really bad blizzard that year. So word started to spread that all those grain-dependent railroads were in deep trouble, and the insiders started to dump their shares. So when things were hot and credit was given out willy-nilly, corruption was rampant. So when push came to shove, all of these bogus landholding companies that were used to speculate on where new rail lines were going to be laid, known as paper railroads, were outed as frauds and began to fall, leading to a sell-off in stocks. The market's confidence turned from bad to worse when major grain wholesaler N.H. Wolf and Company went bankrupt. So the market was spooked, and it was in mid-August of 1857. It was this day back then. The public's fears hit the breaking point. On that morning of August 24th of 1857, a very public investment company, Ohio Life and Trust, which specialized in taking foreign money and investing it into Western companies, was busted for embezzling almost every cent it had and went into bankruptcy, taking with its large mortgage holdings. Stocks sold hard, and it looked like it looked like it could make a recovery, but it was more bad news hit when the SS Central America sunk in a hurricane with 30,000 pounds of prospected California gold on its ship, worth close to $1 trillion today of gold, and was heading to the eastern banks. Now, it's interesting. I don't know if you've ever saw, but back in 1988, there was that big movie and all of that stuff about the dramatic recovery of all that gold from the SS Central America. So you just look that up. It's a really interesting stuff. They found all of the gold and recovered it. But anyway, back then,
really? Whoa.
Yeah.
Okay, I got to take a break here. I'm going to look this up. What is it? The SS what?
SS Central America.
And this ship sank
with 30,000 pounds of gold. And it was in 1988 when they recovered it with all these different robots and stuff. And they went down and actually recovered all the gold. It actually is a great story behind it if anyone wants to look it up. But anyway,
that is a great story. That's better than Elon Musk mining gold on asteroids.
Almost as good.
Almost as good.
Anyway, so look it up while I continue the story. So this loss of gold cast doubt on the redeemability of all those banknotes issued, right? So back then there was no central bank issued notes. It was basically all these banks, and they needed the gold to collateralize all of it. And so this, the fact that all this gold sunk made everyone worried that the coffer was empty, and it created a bank run. And so Europe caught wind of the American panic, which started their own crisis. American rail stocks plummeted along with everything else, and it only began to slow when the banks were forced to take all sorts of holidays. So the market ultimately bottomed in October of 1857, and the general downtrend continued. It brought the financial strife between the American North and South, deepening the divide, which ultimately contributed to the start of the U.S. Civil War.
Patrick, this story about this gold going down and this boat, it almost deserves its own This Week in Trading.
Yeah,
history.
well, we can do that. Let's find out when.
Listen, they used Bayesian search theory to find the boat, and then the captain split with some money after he found it, and then he went into hiding. Okay, listen. I'm not going to say any more.
Let's make it a history piece. Let's let's circle some dates and we'll talk about.
We'll
this
come back
history.
to this because Patrick's on to gold. Okay.
Anyway, that was this week in trading history, buddy.
Okay, time for our WTF clip of the week.
WTF clip of the week. Taylor's online. Taylor, what do you got in store for us, buddy?
So this week, you guys were sent me this Portnoy clip, and it's phenomenal. These stock splits, he's saying that it's only good for a stock. I remember trading like all these really crappy pharma stocks and just getting ripped apart on every one of these stock splits, like back when I used to trade entirely on stock twits. So a real pro. So anyway, I'm just shocked at it. Anyway, so we made a really fun clip, and I hope you enjoy it.
All right, let's watch.
I like it here. It doesn't mean because I go here I'm a genius. I am very smart.
I was just hoping you might give me some insight into the evolution of the market economy.
Anytime you split stocks, that's a good thing. Because instead of having one stock, you have maybe 2 stocks, 3 stocks, 4 stocks, 5. The bottom line is this. When you get one stock, and then they give you 2 stocks, you get twice as many stocks. So when each stock goes up $1, you get 2 of them. That's simple math. If something splits or is about to split, you fucking drop your nuts on the table and you do the trade. I'm not talking about the value, I'm talking about the number. Do you want 1 lamp or 2 lamps?
It's cool. My boy's wicked smart.
That's how fucking trees go. Photosynthesis.
Oh my God!
Well done,
I
Taylor.
love it.
Good movie.
Love it.
Good movie.
It is. But I'll tell you, I think Dave Portnoy's onto something. You know what? For thousands of years, people wondered how Jesus fed 5,000 people in the miracle in the Bible, and I think Dave just figured it out. Because if you have like 5 loaves of bread, and you cut them in half, you suddenly have 10 loaves of bread. And if we just do this over and over again, we can have 1,000 loaves of bread and everyone gets fed. We solved world hunger. We figured out that 2 stocks is better than 1. Like this is the secret to prosperity and wealth for everybody.
What if it is? Like, he has been right about so many things. Now I'm getting to the point where I go,
He's figured it out. He's figured it out. This is how we make miracles happen. We can solve world hunger. I mean, if we do 1,000 for 1 split for Apple and give everyone 1 share, then the world will be prosperous and everyone will be rich. Kevin has no comment.
I don't know.
You want nothing to do with my rant. That's fine. It was stupidity. It's just so stupid. Anyway.
The fact that this is passing as analysis these days just says it all. Really. But anyways, great WTF clip.
Yeah.
Honestly,
thanks,
great. Well done. Thanks.
Good.
All right.
Yeah, check it out.
All right, Kev, it's time.
Top 3 things to watch next week. First, though, we have to do what we go over what we did last week, Patrick.
Yes. And the first one we talked about was their bottom in the dollar. And while the dollar has not made a lower low, it's not looking good.
Yeah.
It's not looking good.
By the way, that number 3 from last week was obviously Patrick's choice.
No, it was a question. There's a question mark at it. I did not say it is a bottom. I asked, will it bottom?
Will my U.S. dollar long finally work? Is what we should have said.
These lows from 2018 may be the magnet if it breaks to a lower low. Now, it hasn't broken to a lower low, but I mean, what's stopping it after it breaks to a lower low? There's not much. I mean, if this gives out and the feet get kicked out from under that level, a couple points on the Dixie is almost a given. Anyway, number 2, Jackson Hole. Well, that's still
shit.
I mean,
how do we put that at number 2? That should have been number 1. I can't even remember what number 1 was, but I guess we'll talk about that in a second. But Jackson Hole should have been number 1. Was it that big a deal? Yes, it was, Patrick. We're going to look back, and this is going to be a monumentous change in attitude at the Fed.
Really?
I don't think people realize and understand how much it means.
Please fill me in.
Seriously?
Well, I mean, I know some, but I didn't consider it a monumental change.
Basically, it means that every other time that we got close to 2%, the Fed was busy putting the brakes on.
But you know what? They haven't been able to produce their target in how long?
100% agree. This is where the one slight nuance that I have versus most people in the market. They somehow think that this alone is going to cause inflation. This won't cause inflation. What this will stop, though, is a 2018 scenario. Just imagine 2018 when Powell came in and he started raising rates because we had a lot of fiscal stimulus. And imagine if they had to play catch up and they had to allow a few years of 4 or 5% inflation before they raised rates. Can you imagine how frothy and crazy that would have been?
Well, you know what? This continues to fit that bigger financial repression narrative, which is you have to let inflation run higher than the prevailing interest rates.
100% agree. But Patrick, the market was hesitant to believe that, and not only that, this formalizes that repression will occur.
But yeah, that will. But the question is, when will the market start to care? Because I don't think that the market's had a big enough reaction on that. I mean, it did squiggle on it.
I disagree because I think that you saw the curve steepen. You saw break-evens go up.
Somebody take the 5-3. Come on, break-evens ticked up. That wasn't a rip.
No, I get it. I think though you'll find that when we look back here, the market will. In the grand scheme,
I'm circling the date. I am circling the date, and we're going to find out whether Kev is right. Listen, you know what? You may very well. I've been betting on the show how many times that inflation wasn't coming, and I'm nervous. I'm nervous about my statement. I won't lie. It's
okay.
I mean,
but Patrick, 1 second. You know what though? I just want to. Sorry to interrupt there, bud. But I just want to say one thing. I don't know if it's going to be 6 months from now that we're going to realize what a big deal it is. I think it's going to be a decade from now we're going to realize what a big deal it was.
Oh, well, that's a cop-out, dude.
No, it's not. It's not because it's arguing that
I'm going to be dead in 10 years, for God's sake.
It's all the burgers you're eating. No, I think it's saying that it's just in the grand scheme of things, this will be one of the things that you look at. It'll be like Volcker going and raising rates in 81. And in fact, the first year, nobody believed him. And it actually, gold continued to run, and there was a lot of issues with Volcker, and it wasn't until kind of a few years later that we realized what a big deal it was and what he had accomplished. And I think that's going to be this magnitude.
You heard it here from Kevin Muir.
If you put it long enough,
you stuck your neck out.
If you put a long enough timeline, everyone forgets what you said.
There you go. I'm going to forget. All right. Number 1, will volatility return this week? Was that really a number 1 versus 2? I mean, obviously, in hindsight, you think so. But the volatility returned, but it was to the upside. That was a bit of a surprise for me, but that was. All right. Anyway, I think that's enough for that. Let's go on to this week's Top 3. There's a reason in the charts that we didn't talk about gold and silver because I wanted to show the charts here in this segment. But really, this is interesting because, I know a lot of people like to look at gold trends as in association with real yields. But for me, I still think that the dollar trend has a very influential kind of tailwind or headwind to the movement of gold. And so if the dollar's breaking down, it's certainly contributing to gold attempting to break out. Now, I'm not officially calling for the next bull trend to have officially started, but this is what we do on the top 3 things to watch next week, is we're going to watch whether or not gold's consolidation is over and whether it's going to break out. And to me, the way I'd put it is that we had a big up day today. I want to see follow through above 2,000 to signify that the trend is actually breaking out. Like it should be breaking these highs back over here with ease, at least next week. It doesn't have to do it in one day. We should see it legitimately breaking out north of 2,000. And the question is it going to be a legit breakout? Like silver held up so much better than gold. I mean, silver has old dips were bought very quickly and is rolling up. Both feel very good, but will we get the breakout? My suspicion is yes, but I also thought the market was going to break down last week, and that means that my opinion is nothing.
I'm nothing.
What's your call?
I was actually somewhat negative on gold for the short run, and I must say that I've over the past couple of days I've gone officially neutral. Like that was a trading call. I was negative, and I covered a lot of that, and I'm back to my long-term bullish view on gold. So I think you could be right.
Well, we'll find out. Well, right or wrong, that's what we're watching next week, is whether the break is a breakout or a fake out, and that's number 3. Number 2, we have the jobs numbers and ISM numbers. Now, listen, there was the last couple months was just simply reflexive data from an incredibly oversold rate. Like the jobs numbers were so artificially low from that, not artificially low, but so low from a government-induced unemployment rate. And so we've been seeing recovery, but I think now that every month that passes, we're going to start to see that no longer the reflexive kind of positive rate of change off of a very extreme low to now what is the new trend that emerges from all of this data? I mean, what's your view on where we're going on this data from here?
I don't know, Patrick, because I'm kind of at a loss because the reopening is kind of being it's gone in fits and starts in the U.S., so I don't have a real good opinion.
Is there an economic double dip? Forget about the stock market for a moment. Is there an economic double dip? And don't give me this shit that it depends if Corona is under control shit.
No, I wouldn't say that. No, I wouldn't say that.
No, but is there another economic wave of and it doesn't have to be worse than where it was in March.
Okay. I'll tell. So 1 second. What happens on the fiscal side with the Congress?
So, but I mean, does anything happen before the elections?
Sure. We're busy trying to get another stimulus passed. So if, for example, if they go to the wall and that doesn't get done or it ends up being a smaller one, then I think you could.
I mean, isn't there a legitimate chance that because of the elections, things just get tied up and doesn't happen?
For sure. And that's the case, then I think the economy does stumble. I think it's driven by...
Will the stock market care?
Yes, I think it will.
No, it's going to be really interesting to watch what happens. Anyway, we'll see what the data comes in at next week. It's definitely one of the top 3 things to watch. Anyway, number 1, Kevin. I mean, we already kind of touched on it, but I think it's pretty critical. Will the Tesla and Apple stock split be a buy or a sell on the event?
Well, I gave it away. I wasn't supposed to talk about it earlier, obviously, but
you weren't.
Yeah,
you weren't.
I don't listen to any instructions. Yeah, but I think it's a huge sell. Sold. I'll tell you this, Patrick. Tell me somebody that is willing to sell Tesla up here now. There's nobody. No. Everybody's so scared of it.
Yeah.
Right? Like nobody wants to sell Tesla.
Everyone's getting squeezed. Everyone's scared.
Well, I don't even think they're getting squeezed anymore because nobody's left short anymore. I think there's no shorts left. None.
Really?
Yeah.
At least all the ones that were able to be shaken out. There's probably some shorts out there that at this point they're pot committed, and there's no way they're covering.
Well, I don't know. I think that there's guys like Einhorn and Chanos who really believe that this is a good short, and they're forced to cover as it goes higher because when it's let's face it, stock doubles on you in a few months, then your short is worth twice as much.
You have to lighten up.
Yeah. So they're by its very.
So as far as you know, Chanos didn't cover, right?
I'm assuming he's covering because it's headed higher, and he's just to maintain his same percentage short. He needs to bring some in, but I don't believe that he has said, "Oh, I'm wrong and I'm getting out." He still seems to be each and every time sticking to it, and I think that while in principle I agree with you, my intuition is that it could not be an official prairie dog the way we would define a prairie dog, but the idea is that the first impulse on the stock split will be a very temporary surge. It might only last even an hour or two, but it's first higher to kind of draw everyone excited, and then it starts selling. Okay, that's my view. I just think that there's I'm in principle I agree with you that it will sell on the split. I just think that there's room that once a split happens that everyone kind of there's like an excited surge of the I don't want to say dumb money, but the money that's tracking the excitable
Dave
money.
Portnoy. The excitable money kind of gets a wave of money in there.
Could be,
and then
who knows?
On the back. All right. Anyway, enough of that. We'll watch. That's definitely the top 3 things to watch next week. So, Kev, why don't you quickly read for us this old French proverb for the parting words of wisdom?
So it's buy on the cannons, sell on the trumpets. Very fitting, Patrick. Do you think there's cannons or trumpets right now?
Well, no, the buying on the cannons it's basically buy rumor, sell news, right?
Right. Well, it's buy war and sell the victory.
Right, which is the same principle.
Right.
And this is why it's so fitting that the stock split is sold on news.
Right.
I like it. I think that the stock split is the trumpets.
Well, let's hope. Well, that's our show for this. That's our main show for this week. We appreciate you all tuning in. We couldn't do it without you. I'd like to thank David Bezic for a great interview. And if you like what we do over here at Market Huddle, please share it with your friends. You never know. The bigger our following, the more chance that we'll have at getting like Dave Portnoy on the show. Do you think he'd ever come? I don't know.
Not after all the WTF clips.
I don't think so either. Like Taylor keeps saying, I hope he tweets, and I go, it's not always flattering there, bud. Anyways, before we get to the after show, here's where you can find us. You can listen to us on Google Podcasts, Podbean, Spotify, Andrew Play, iTunes, and YouTube. A lot of people watch us on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. You can follow the Twitter at The Market Huddle. Make sure you give Lena a big hello. She's the one in charge of that. And if you could, please rate or review us on iTunes. It helps us out immensely. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, and you can find me at bigpicturetrading.com. Kev, where can they find you?
So Twitter, it's at Kevin Muir, and for the website, it's themacrotourist.substack.com. Anyways, listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in, and now stick around for the after show.
Nice.
Okay.
Jump on,
Youngins.
Lena.
All right.
Taylor.
Great.
Oh, so how's everyone doing?
It's so good. I'm at a cottage in Lake Huron in southwest Ontario. It's beautiful. Got out of the city. Never going back. Best.
I'm never going back.
You gotta enjoy the rest of the summer, the next 3 days. Right?
Yeah.
Where are you on Lake Huron?
This place called Kincardine. I actually grew up here.
Oh, I didn't know you're from there.
Yeah.
Oh, wow.
I was the only kid in town who didn't play hockey, so it was fun. A lot of fun. Yeah, it's beautiful here though. Like the beautiful beaches and all that stuff, and we're just really happy. Like we're paying another $500 a month, but we have a full house with double-story windows, and it's just it's like a writer's retreat here. It's crazy.
Nice. Right near the nuclear power plant.
You know, that trend seems to be, and I mean, this is what's driving lumber and new home sales. Kev, how many times you've talked about it, and we've heard it from so many guys like Josh Steiner as well. But there was always going to be this trigger that was going to send millennials out of the city and into the burbs or into the outskirts. And we've always talked about what will do it. And it's amazing that the COVID-19, the coronavirus, ended up offering a catalyst for a lot of millennials to make a transition out of the cities. And what Taylor's talking about, I think, is really something that's happening on a much bigger level, wouldn't you say?
Yeah, I agree, Patrick. First of all, why did you kind of change your opinion when you were going to say COVID-19 and then you changed it to coronavirus, like COVID-19 is a bad word or something?
No, I don't know. I just it didn't flow nicely off my tongue.
You were worried it was COVID 2020 or something. Is it really 19? By the way, on that podcast, did you talk about this on the podcast that you cheat on me with?
I mentioned it. Yeah.
Okay, and did you mention...
Patrick doesn't read your newsletter and you don't listen to his podcast. So
okay, that's the truth.
You know?
Touche. That's funny. Anyway, so let's. So you're on the ocean or on the lake. It feels like an ocean though.
Yeah, it's real nice. But like we're looking at Airbnbs because we're doing this until we buy a house, pretty much like in the new year. And we're just hoping for like a correction. But we got this place for dirt cheap, and like 2 or 3 months ago, and now all the places are going like there's none left, and they're all like $4,000 for like a piece of garbage in the woods, and you're like, go away.
Yeah,
go away.
Well, you obviously booked it in the Corona crisis. Panic, which is nice, and then all of a sudden everyone decided they wanted to be at the cottage, and all those went bid. I saw something that from they've never had more cottage sales in the Muskoka area. It's all-time highs, and it's crazy. Because boat sales are through the internet.
Yeah, and
internet.
Long as you can get high-speed internet, the place is booming. Everyone is just running away from the cities.
Yeah.
Yeah.
There's about 10,000 listings in Toronto right now just for rentals.
Just like vacancies.
Like downtown Toronto, like condos.
If I was looking at this, I would be selling my Suburban and move into the city. I'd be fading that.
You'd fade that.
I'm a fader. Well, you know me. I'm a contrarian by heart.
You already live in the city.
It won't be long. It won't be long before the Gen Zers start partying up the downtown cores. It's just a cycle. It's time for the millennials to.
That's true.
Go and
you know what?
Babies.
Get out of a shoebox.
That's true.
Make babies, and the Gen Zers are gonna. It's gonna be a transition.
Yeah.
It might take 5+ years, but it'll happen.
Yeah. No, you're right. But I see all these talk about the end of New York City. I'm a seller of that. I think that all these great cities, big cities, have been the place that young people and artists and musicians and lots of people wanted to live. And usually the only reason that they didn't was because they got priced out. And yes, I do understand that when there's a virus that you don't want to be living on top of one another, but someday that'll be gone, and you know what? It'll go back to the way it was. So I'm a buyer of New York City. I'm a buyer of Toronto. I think that the move in the suburbs is short-lived, and people will want to be coming back into the city as soon as things return to normal.
Well, when they realize the prices out in the suburbs are ridiculous. Because if you look at some of these listings, they're ridiculous. Absolutely ridiculous. Like unlivable places for $4,000 a month. And you're like, no.
Well, it's because, I have a buddy that moved.
600 square feet.
Has a condo, and he's having a child, and he had to move out to the suburbs. So because of his second child, and he was telling me that he had to compete to rent. Yeah. And he said, meanwhile, in the city, they're handing out extra months or two if you want like a condo in the city.
Yeah. It is.
Because it used to be the other way around.
Oh,
right?
totally.
It used to be the other way around.
Totally.
Now it's like, Luke and I are looking for a place, and we can't get to a place soon enough. Like we see a place, we want to put in an offer, and it's already gone by the time we get there.
Yeah.
So, or there's like a bidding war on
I know,
rent.
it's weird,
Like, it's kind of crazy. Yeah, so we're kind of being like,
but it's
do we
crazy
need to go
because
back into the city?
in downtown Toronto, the average place was like $2,800 to $4,000. It would be a typical condo or something like that. So to grab a house in the burbs for $4,000 is pretty much a lateral move for most millennials. Like they
Not really, if you look at these listings, though.
well, I mean,
Some of these houses are
some are a
unlivable.
little more expensive, but generally. At least before this craze really got fueled. I mean, you could rent a house in the burbs of Toronto for under $3,000 a year ago. So yes, there's been a massive rent inflation in the burbs in the last couple months because of this, but it's because of the fact that it's a lateral rent move. Now that's being priced out, but it's crazy that it's happening. I think it's just nuts. I wonder whether, listen, for our listeners that made it this far, let us know if this is happening in your city. Like, I'd love to know. Like, this is crazy in Toronto, but is this happening everywhere?
Yeah, and I'd like to ask you guys something here, because like what's happening right now, it's my wife and I's like first time going through something like this, and it's like we're out, we're waiting for a dip and all this stuff. How familiar and like how familiar is this like mania, FOMO? Okay, is this like the end of our financial life? Are we going to get back in? How often? It feels like, looking back, that these events, huge emotional events, happened all through time and every market crash and all this stuff. It's a very long-winded question, but I want to know, how often does this happen? Because it feels like it's a once in a lifetime for us, but you guys, Kevin, I'm sure you've seen it 50 or 60
I'm so much
times.
older.
It's been around.
It's 150 years of market.
You know what's funny? I think I'm 2 years older than Patrick, and I it's because I'm bald, like, or something.
Yeah, I know.
It's like, I'm like, are you asking me
And a
how
couple
often these
extra
market crises happen?
Yeah, like yeah.
Or
I
are
guess
you
it is-
talking about
this-
the fact, like, are like, how often do you feel like you're never going to get it? Get a
Yeah.
place because it's so expensive. So
Yeah, that.
basically, I bought my first house in 96, 97.
Before we were
96,
born?
97. Maybe it might have been before you guys were born. And I remember at the time, I was lucky enough, I was at a bank and I was doing well and I was young. And it was the start of people competing. It was just at the beginning of people competing. Up until this point, nobody ever paid through an offering. And I remember we looked around, we couldn't find it. We couldn't find one. Finally, we found one we liked, and they went out there and they said it's sold. And I was like, well, is it really sold? Like, and they said, well, they're looks like someone's willing to pay the offering. And I said, okay. I said to my agent, okay, let's bid. Let's bid through this. And so we went through it, and I remember talking the numbers and figuring it out. And I said, well, nobody's gonna, if it's already sold and they've already done it, nobody's gonna move it for this much, like extra, and whatever it was. I said, we got to bid this much extra. And the guy kind of looked at me like I was insane. And at the like, if I told you the number, it wouldn't seem like that.
What was the percentage?
Yeah.
then? Like what? Like 10% more or something?
No, it wasn't even that much. Let me just tell you, because this is like I can just tell you 1 second. So it was 3.5% through.
Oh,
Yeah,
okay. So
it
not
was
that.
3.5% through, and it wasn't anywhere near 50 grand. And the agent looked at me like I was insane. And then we won it, obviously, and we were very happy, and it ended up being a great trade because they went straight up. But I think ever since then, I think that was like the first year that people started bidding through. It's been that way ever since then.
Ever since.
I don't ever, like, yes.
You started this
I
fucking
did start
trend,
it.
you asshole.
started.
Yes, you did. You piece of shit.
Yeah.
You're the one.
The bid through. No, but okay, so
Pricing out all
so
the
I'll tell you,
millennials.
there's been a couple of times
happening?
when it
You
declined.
know how you can even make more money on your house?
What's that?
You should do a house split. You should cut your house right in half.
8.
And then you'll have
8.
2 houses.
8.
Two houses
And-
is
Who
better than
doesn't
one.
want
No,
more
and-
houses? Everyone wants more
Yeah.
houses. It's always
So just split your house in 8, and suddenly 8 houses are
you know what
better
the thing
than
is,
one.
it probably would work if you did that. That's why. So back to your Taylor,
I call
back
your
to your
garage.
question.
I call your garage.
Back to your question. I've seen like 2 decent dips, or not even 2 decent dips. 1 decent dip. In 08, we had
was
we had
that?
a decent
Oh.
dip. And I remember watching, if you had to sell in that scary summer when things were really no bid, especially in my neighborhood where there's a lot of finance people, like there was a couple of trades, like people getting divorced and stuff, that there was quick, I need to sell, and you could buy a house like at 20% off. But then as soon as the thing rallied back up, it just took off again, and it's never been going down. So Taylor, I don't have any advice for you because unfortunately it's been going up for like 3 decades. So I don't know what to tell you.
Well,
Stocks only go up, and real estate only goes up. What could go
I
wrong?
know, but
Just
you know
buy.
what's funny is amazing. You go look at Chicago, very similar type city, and you go pick one of their houses and you compare our 2 housing prices, and you look at the history, and you would have gotten crushed in Chicago, and you would have done terrific in Toronto. Someday, maybe that trend changes. I don't know.
It's all about our central bank. They just keep shit under control here.
So one more
Ample
thing here.
liquidity.
I actually
That's
think it
all
has
you
more to
need.
do with immigration than it has to do with anything else.
Yeah.
Oh my God!
You don't
Let me
agree?
tell you.
Vomit a little bit in my mouth.
Why? You
Oh,
don't think it's
no.
you don't think it's immigration?
You know what? Stop it! Stop it! Stop it! Stop it! We're not getting into
No,
this.
but I
'cause
don't
this
think
is-
it's a bad thing.
This is regular show content. Like, what are we going to save this for the end of his show?
Okay.
I could
Okay,
get my
Taylor.
punching gloves.
Taylor,
out.
what do
Yeah,
you,
let
what do
me-
you want your question? Go ahead.
I have one more thing,
Yeah.
and that is, I know you guys are smart. I know
Oh my
how
God.
smart you guys are.
His first mistake.
Yeah.
And let me tell you, I know you're smarter than giving me the answer you just gave. I know you really know what's going on, and you're not going to tell me because
No,
you
I
don't want to look.
I
bad.
don't have a. You know what? I'll give you some advice. That housing ends up being a personal thing. You shouldn't go and stretch and take too much in a speculation. But at the end of the day, you need to pick something for you and your wife to make a family or do whatever you want to do. And it ends up being you shouldn't let obsess with it too much.
And more importantly,
Easy for you to say, living in the neighborhood you live in with a house
Okay.
that you own.
okay,
you
but
know?
no, but I will say this. I'll support Kevin on this one thing, which is that listen, because of the way we tax houses, the primary residence in Canada, having your first home is always a reasonable proposition. It's really about leveraging up real estate. It's when you're talking about owning 2, 3, 5, 10 properties,
Or owning a house you can't
and
afford.
more importantly, or a house you can't afford and you don't have a consistent job or something, that's where all the question marks. But if you can carry your house and you have a good situation, that first home, it's one of those things that you live in and raise your family, and 20 years from now, you're probably going to be okay, and you're just going to ride out cycles, right? Like it's
Plus,
I wouldn't
inflation's
overthink it.
coming, and it's going to make all these
Oh
things
my
in nominal
God.
terms seem way higher. So,
All right,
strap
this
it
is
on.
almost
strap
too much
on,
for me.
strap
This-
it
okay,
on
wait,
and-
hey,
Yeah,
we have to rate this beer.
yeah, we do actually.
Oh, right.
Okay, I'm going to
What category are we
start.
talking
I don't
about?
like it as much as you guys do. I'm giving it a 7,
Oh.
7.4.
What the?
Yeah,
You are no. That is like
Why are you
I
surprised?
don't like it as much.
no,
as,
but like the guy. No, but you know what? He basically last week. What was our beer last week? I mean, you gave it like what, a 9 something. It was ridiculous, and now you're going down to 7.4 for a good clean pilsner.
yeah, I don't like it. I guess
No, you know what? There is. I'm
no,
embarrassed
last
for
week
you.
I think he was drinking White.
Yeah, I did.
Oh my God! You rate.
Yeah.
I didn't rate it. Okay,
that's-
so
no,
Patrick,
no, I
okay,
understand
you're a
now.
big talker. What are you rating this?
I'm giving it 8.8. It's a good beer. It's a good beer. It's sessionable. I love that
Okay,
word.
well,
I love the
I
word.
know you-
And I would in a heartbeat buy a 6-pack of this and sit down and watch a movie.
Patrick,
and
you say
pound
that
these
for every
back.
beer.
This is
Okay, so here
no,
we go. Whoa,
I do
Patrick.
not say that
Whoa,
for every
let's say
beer, and this is sessionable. It's a good pilsner.
Let's see what
I just gave
let's-
Rorschach a good endorsement. Done.
So let's see what the youngins think. Okay, Lena, go ahead.
I really like this beer.
Thank you.
actually. It was a really nice, refreshing beer. I feel like maybe we haven't had a Pilsner in a while. Maybe that's what it is, but I really like this beer. I would give it a
Oh my
9.5.
God.
Woo! Love it.
Okay, Taylor.
Yeah.
You got
Okay,
to
well,
be
you guys
low,
are-
buddy. Otherwise, I'm done.
You guys are always saying, "Give me numbers, give me numbers." Well, I'm not going to give you numbers. This is the type of beer. You're traveling in another country. You sit down on a patio. You go, "What's good?" If they give you this, you drink it. And you go, "This is perfect." That's exactly what
there
this
you
beer
go.
is.
That's a good line.
Okay?
That's a good
So
line.
whatever
I like
number that is.
What number is it? Come on, give us a number. You got to play the game.
No,
you got to play the game.
No, he's sticking to his thing. He's giving no numbers. It's just
Yeah,
because
no
he gives
numbers.
amateur numbers. You give it a
You know what? I'm
He's
I'm
got
an emotional guy.
11.4.
You know
11.4.
I'm not a quant. I'm not a quant, Patrick. Okay, I'm sorry. I play the markets with my emotions, and that's how I still lose.
Oh, that's good stuff. Okay.
Okay. Listen, I think that was a great show. Good stuff, guys.
Terrific.
You know, lots for us to watch into Labor Day. We'll put another great show, and then everyone that's made it this far, just so you know, we're gonna be kind of juicing up the format a little bit. I'm excited that we're gonna try something little. Well, listen, we'll surprise everyone.
I don't know. Why did you say anything, Patrick? Giving it away as usual.
Yeah, now people are going to
Well,
expect
they are
something.
Just juicing it up. All I said was juicing it up. I didn't give anything away, Kevin.
Okay. Okay. We are going to juice it up. That's a good thing. Okay, stick
All right.
around.
Anyway, have a great weekend,
Okay,
everyone.
take care. Bye-bye.
All right, cheers, everyone.